Today, folks, it is that time of the week where I offer full clarity into the transparency of my stock portfolio for all you finfluencer clowns out there that want to join me on my financial independent journey as we see spattered performance across the S&P this week, mostly finishing flat with every sector seeing some gains, some losses, whereas on the back of recession fears, tariff wars, Canada is actually outperforming the S&P, which kind of came as a shock to me with energy financials leading the way, the hardest hit sector being industrials. All of this leading to my stock portfolio as of Friday only being down 1.65%, which comes as a bit of a shock to me personally, but I'm still waiting for some juicy fat checks, baby. I want to invest some dividends here. I'm waiting on the SCHD dividend, which is supposed to be reconstituting its holdings today. Probably do a video on that tomorrow, but between SCHD and VDY, I think they're leveling off some of the losses that we're experiencing in VOO, but I want to break down analysts and see what the price targets are on my individual holdings, with TELUS getting absolutely clobbered today. We'll talk about Take-Two Interactive, Aduro, Google, all my favorite companies, and my long-term outlook for how I want to see my portfolio start to balance out into the end of the year. So if you are on that path to financial independence, join me. Hit that subscribe. If you want to support the channel like so many do, go to kylelivingston.com. I've been doing a lot of one-on-ones with so many of you out there, and it's incredible to see the age difference, capital difference, and everyone's individual journeys. It's a beautiful thing to continue to build this community. But diving into this first and foremost, let's talk about the indices themselves, like the S&P's VOO, with, like I said, over the last 5 days, mostly finishing flat, but year to date, still down about 3.63%. Looks like it's kind of getting stuck here. Whether we go higher or lower is anybody's guess to me. I think earnings are going to be the defining factor to where the market goes, because we've been stuck in the middle of this kind of tariff war, recession fear thing since the beginning of the year, since Trump has kind of, announced a lot of these new policies. So we'll see what it actually does for certain companies and how it affects the market very soon, which is why, to some extent, not because of that, but I am starting to invest into XEQT. I told you guys my primary goal with the overall portfolio is to get about 200K in the S&P 500, which I plan on finishing up by the end of this year, regardless of what happens with Take-Two Interactive. That's a short-term play that will probably all get dumped into the S&P, taking me up hopefully to over 200 grand invested. And then I want to get about 100,000 in VDY and 100,000 in SCHD, which I already have 100K in SCHD. But beyond that, with the few individual stocks, I really want to start moving forward from there, cost averaging into broad-based ETFs that give me global market exposure for when China, for when Europe and these other markets perform better, because over 5 days, we're up about a little bit more than the S&P, but year to date, this is actually a green ETF because of that global market exposure, right? And I feel like you get a little less upside, but a lot more security. And as somebody mentioned in my chats in the comments below, that XEQT paired with VDY, for example, almost works as like a bond ETF, because you get a really great combined dividend, but you get that global market exposure, removing some volatility. But if we take a look, VDY is actually up 1.17% so far this week, doing much better than the S&P and all these other ETFs. Year to date, only down about 0.59, so mostly flat on the year, comparable to SCHD, which is, up a little bit more than the S&P this week, but year to date, it's actually up 2%, doing very, very well. These are what I'm going to call more interest rate sensitive recovery plays. Dividend stocks are mostly infrastructure, or they're old school companies. They typically have a lot more debt. They're not as resilient, in my opinion, as, say, something like a Google or some of the Mag 7 stocks, even though that's where most people's attention, I think, should be right now, because they're getting absolutely clobbered, and there's some opportunities there, right, for those incredible balance sheets. But when it comes to dividends specifically, right, like if they cut interest rates like we saw in Canada on the 12th, I mean, we got a huge bump in VDY, and obviously the Fed doesn't plan on cutting rates materially until the end of this year, but I'm holding SCHD, presuming that's when this thing will really start to kick in gear. And in the meantime, it's giving those dividends, it's taking away some of the volatility in my portfolio, and, obviously not giving me the same downside risk if I was just exposed to these tech companies and VOO. So that's kind of the ETFs and where they currently sit. But if we look at the individual stocks, we'll start with TELUS being down 6% over this last week, kind of getting back into the $20 range. And I told you guys, I'm presuming we're finding a bottom here. Now, the reason the stock's dropping, as far as I can tell, is we are getting some, analysts coming out that are cutting their price targets to neutral, lowering their price target to 22. And this is a pretty interesting article for those that are interested, because the reason reasons for the downgrade include concerns about TELUS's leverage, which the firm has considered unsustainable. There are concerns supporting Investing Pro metrics showing a debt to equity ratio of 1.91x and a current ratio of 0.68, indicating that the short-term obligations exceed the liquid assets. Additionally, BofA noted that TELUS's dividend payout exceeds the free cash flow, representing potential risk for the company's financial health. Another point of caution highlighted by BofA was the report FCF, basically, which includes contributions from consolidated subsidiaries that cannot be utilized to meet dividend obligations. And obviously, this sounds highly concerning, but as mentioned, these are companies that have gone through quite a wild roller coaster with revenues remaining relatively flat, right? So if revenues aren't changed, why are all these concerns now coming up? Well, it's because of net income, right? But like I said, I think we're in an interest rate recovery play here where the debt's going to become a lot more reasonable as interest rates continue to drop, get closer to 2%. On top of that, we are seeing the recovery now because they went through mass layoffs, huge restructuring costs, so much more. But I'm presuming that we're going to continue to see a growth in net income. And you got to keep in mind the depreciation and amortization costs. This is also a company that has been diluting us as shareholders, which is, again, you can look at all the different models based on the balance sheet. But if the company's going to dilute us as shareholders to bolster its cash, pay its dividend, something that Bell's starting to do, so long as the market remains liquid, it's going to offer downward pressure, but it's going to keep them financially set, right? So I don't like seeing a lot of that stuff, but again, the stock's been hit so hard that their underlying asset value, their enterprise value, is still worth more than the company is, which is why their price targets are still higher than where the stock trades today, right? I mean, we're seeing a low price target of 20, a high of 29, and the average around 23, 28. I'm just holding this, waiting to see what happens over the next quarter or two, presuming the recovery will continue. Time will tell if I'm right or wrong, but I wasn't expecting the stock to just vertical line here. Something tells me we're going to be stuck between a $19, $21 range if we keep moving forward. At least I hope. I'm not a financial advisor, so do buy the stock with your own risk. It's a very small percentage of my portfolio at about 1.3%. But when we're talking about Google here, Google to me is the cheapest S&P top 10 company. It should be worth probably closer to about $3 trillion, more in line with a 25 to 30 PE multiple, if that's what we're getting on companies like Apple and Microsoft, considering this is a much faster growing company. But on the back of recession fears, people cutting ad spending, I get that we can go through some cyclical nature, but these are recession-proof companies because they will not go anywhere. Between Meta, Google, you're talking about two companies here that probably control over half the world's search results, social media platforms, and they're going to be around for a very, very long time. So when they drop, it's typically a buying opportunity, incomparable when you look at the growth rates of Nvidia and Tesla. This really falls somewhere in between and should not be trading at a 21 times multiple with all the growth vectors this company has. We got analysts right now price targeting it between 184 and 240, and I think that's fair. I think the company should be trading at well over $200 a share because again, it should demand a lot more. But I get the fears again of the recession, people spending less on ads, concerns, especially with the monopoly fine that's coming up in April. But that monopolistic court case might cause them to sever off a part of the business, and if that happens, guess what? I think it bodes way better for us as shareholders because if we can sever off a part of the business that's going to be large enough to be an S&P 500 company, typically they're better in their own parts than they are in a whole company because they don't get recognized in their full value, in my opinion. Again, look at Tesla, all those future prospects. Google has a lot of great prospects just like that, and none of that gets priced in. So like I said, you're paying fair value, in my opinion, for YouTube, Google, the cloud, their basic services, and everything else is just the cherry on the cake. But putting that aside, let's talk about Take-Two Interactive, my biggest short-term speculation of the year. It's a large market cap company. I bought it at all-time highs. People think I'm nuts, but it's actually one of the best performing stocks because it really hasn't gone down that much since it announced those earnings back in February, right? And I have a big speculation that goes well beyond any analyst price target right now, and it's gonna be hilarious to see if I'm right because basically the low analyst price target's 135, the high is 270, and we're literally caught right in the middle for the average price target. I'm speculating this is going to be a $500 stock somewhere by the end of the year, just purely on GTA 6 hype. I think the stock is under anticipating analysts. I mean, they think GTA 6 is only going to sell somewhere between, it's going to generate somewhere between 3 and 4 billion by a year after the game is released, and I think that's insane. I think the game's going to sell somewhere between 50 and 100 million copies. We can debate this all day. I think at $100 a game plus, it's going to generate somewhere between 5 and 10 billion, taking the 12-month trailing, which is basically what they've been experiencing for a year or two now. They're projecting out 5 billion, but I think they're going to do somewhere between 10 and 15 billion. And I think their profitability, when we look at net income here, which has been negative 3 billion, I think we're going to go somewhere between 2 and 5 billion of net income. The company is going to become profitable. I think GTA 6 is going to be so much more hype than anybody's actually anticipating. And I think the stock has a real capability of, running up to a 60, 70, 80 billion dollar valuation, which would take it up to somewhere probably between a $400 and $500. Like I said, doubling at minimum my investment from here. And that could be completely wrong. I know it's insane. It sounds nuts. Time will tell, just as much as my speculation with Aduro Cleantech. And Aduro Cleantech is a company I'd like to scale up to a position the size of Take-Two Interactive, but I really need to see some solidification, from some of their client programs right now, because they need to start converting clients. And it's a bigger speculation than it is with Take-Two, because I know Take-Two is a fundamental business where the downside is limited, but I mean, this company comes with more risk, but the upside is much, much more substantial, which is why I don't have to make it as large of a position to see that substantial return. And you're going to be blown away to think a price target for an analyst right now is at 49.66. We have one analyst that thinks this is going to be a $50 stock, which is mind-blowing for hydrochemolytic upcycling, taking waste plastic back into profitable fuels, a company that's going to become a leader in the space with the superior technology that it does have, and the 10 clients that they're currently testing this with, all being multi-billion, all above $40 billion plus market caps and stuff, is just mind-blowing to me. So I'm very excited because, I've got a sizable position. I bought a bit more over the week. I think, was it this week or last week? Either way, I bought a bit more because I'm just, when it drops below $5, it just seems kind of cheap to me here at a $200 million CAD market cap. But once they get their pilot program up and running, they convert one client, I think this immediately jumps up to $1 billion value, which will fall more in line with Pure Cycle's market cap. And Pure Cycle is just leading because they were a first mover advantage, but they don't have the scope or capabilities that Aduro does. So I think Aduro, once it catches up to the level Pure Cycle has, is that people will wake up to the true realities of where this company's headed. And I know I'm looking at only holding it for about a year, but something tells me if the company continues to execute, I might hold on to it for much longer and just take a bit of profit off the table if it does what we think it's going to do. But time will truly tell, as it is my short-term speculation. And all of that leads into where my portfolio sits today. But the long-term vision I have with this portfolio is to get the dividend overall somewhere between 2.5% to 3%. And that'll come in line because XEQT has a higher yield of around 2%. But if I cut Take-Two out, put that in the S&P, I'll get another higher bump because Take-Two doesn't pay anything. I'll continue to scale VDY to 100K position, and all of this should bolster the dividend a little bit more. I'd like to get closer to 3%, but again, I'm agnostic, don't really care about, the dividend yield itself as much as I care about the total return and the wealth preservation of my stocks, because I'm a guy that doesn't mind taking profit overall, but I like the balance, the lower volatility, and just collecting enough income for those tougher market periods, right? Because it's hard holding tech in markets like this when you have no income, right? Or you have low income that you can contribute. Because even I'm only making 8,000, in a yield annually right now, but that $8,000 goes a long way, especially when we're sitting in a month right now where we should be collecting well over 1,000 or 2,000 bucks in a dividend that I'm just patiently awaiting for. But SCHD should also be reconstituting today. I think they're going to reconstitute their holdings, which we'll talk about maybe tomorrow. But I don't know, just a quick overview, folks. I love talking about stocks. I think you guys do as well. So let me know what you think in that comment section below.